Hey everyone, me Kevin here. We have a lot of updates on what the heck Joe Biden just said. We've got updates on all the crazy new taxes that are coming in. And folks, I don't know what to do, but I think there are going to be a whole lot of extra taxes coming. It's going to be pretty crazy, but we're going to talk about it, okay? Anyway, so Democrats and Joe Biden have announced their scaled back $1.75 trillion Build Back Better plan. This is 50% of the expected cost of what Joe Biden wanted, which was $3.5 trillion. This is for the social infrastructure plan, not including the $1.2 trillion already passed by the Senate, waiting for the House to pass it on the hard infrastructure package. This social infrastructure package right now, the scaled back version, is expected, and after I go through this, we're going to go through some of the tax changes, is expected to include universal preschool for all 3 and 4-year-olds, which is funded for at least 6 years. That is 6 years of government funding for this program. Subsidized childcare that caps what parents pay at 7% of their income, also funded for about 6 years. A 1-year extension of the child tax credit. Right now, that $300 per month for children under 6 and that $250 for children under 18 for most filers is expiring this tax filing season. So it's only been passed for 2021, which means you get those monthly payments from July through the end of 2021. The monthly payments then stop. You claim the other half in your tax return when you file, so likely in April. Now, if this gets extended for another year, your monthly payments would continue throughout 2022, and you'd still get that extra bonus when you file your taxes for the rest of 2021 in April, which is awesome. So it'd be extra funding, extra stimulus. Expanded tax credits for 10 years for utility and residential clean energy, including electric vehicles. We still don't have the exact details of this, how it'll include or exclude Tesla, for example. Extend the current pandemic-related Affordable Care Act subsidies for an additional 4 years. There's also talk, and there's been a lot about this, but it's also expected to include allowing Medicare to cover the cost of hearing, but I don't see dental or vision right now. Now what we need to do as well is talk about all of the tax changes going on and how they might affect you, people you know, or companies that you patronize. So first, look, there's a lot of bickering going on. At this point, we still don't know when this is going to get passed. We hope it's within the next few months, or these things could essentially die if we don't get this done this year. Who knows? We could end up having a disaster come early December as these packages try to get passed. And then we have, again, the budget deficit and debt ceiling debate and potentially government shutdown debate. And all that ends up coming back before the holidays in December. But anyway, right now, so far, we have a pretty good idea of what kind of taxes we're expecting and the odds of each of them. In fact, Bloomberg put together a phenomenal piece on this, breaking down what's likely in, likely out, and definitely out. So what I'm going to do here is I'm just going to give you a quick idea of what these things are. So definitely out. Okay, this is a big one. Very, very important. If you want to build wealth, you got to know about this one because it affects the way you invest. It affects the way anybody invests, everybody, no matter what your income is. So, and I talk about this regularly in the Stocks and Psychology Money group and the Real Estate Investing group. That's because this is very important, and we like building wealth. By the way, there is a coupon code expiring for this program tomorrow evening. That's October 29th in the evening. And then the next day on Saturday, pricing will be going up for all of the programs listed down below. Use that coupon code, 41% off, before the price goes up. So definitely out. Eliminating the stepped-up tax basis on inherited assets. So here's how this works. Let's say throughout your life, you start with a little 2-bedroom house, a 2-bedroom condo or whatever. Then you buy a 3-bedroom, 2-bath. Then you buy a 4-bedroom, 2-bath. Then you buy a 5-bedroom, 3-bath. And then you retire. And let's say you kept these 3 properties as rental properties and you never sold them. And now over your life, you've accumulated all of these assets. And let's say it cost you about $2 million to buy them all. And now they're worth, let's say, $10 million. And because you've depreciated the rental properties, let's say you'd basically, if you were to sell tomorrow, you'd have to pay taxes, to keep things simple, on the entire $10 million if you were to sell. So if you were to sell, you'd probably have to pay somewhere around $2.5 to $3.5 million in taxes. Well, let's say you're 95 years old now and you're like, okay, I'm going to sell everything. Well, you're going to pay that $2.5 to $3.5 million. And let's say you decide to do that today. You sell everything today. You pay $2.5 to $3.5 million tomorrow. Then tomorrow you get hit by a bus Well, the government comes along thanks to this stepped up tax basis and says, sorry you died, let's just pretend you don't owe us this money anymore. And they waive your requirement to pay that kind of money in taxes, so the very next day your family could sell and pay no taxes at all on that $10 million. That's how the stepped up tax basis works, and removing any changes, making any changes to that is out. So no changes here, which means it is still a good idea to invest long-term in real estate and stocks, especially real estate, because you can 1031, which you can't do in stocks. Which basically just means deferring taxes over and over and over again going forward until forever. So now, Billionaires Tax, we're going to talk about this in a moment, but this is right now actually listed as likely out. IRS bank reporting requirements, this has been a really politically hot and politically charged issue. Basically, this is where the IRS and the Congress were initially saying, hey, why don't we make it so that banks have to report any the net inflows to people's accounts and the net outflows to people's accounts? So that way, if let's say you had $100,000 in deposits, but you only spent $50,000 or $50,000 of outflows on your account, and now you're only reporting $25,000 in taxes or taxable income, what happened to the other $25,000, right? That's what they want to be able to track. And so they want to see net inflows, net outflows, and they were going to do this by requiring all transactions over $600 to be reported. That has so far been so politically unpopular that now they're thinking about any transaction over $10,000, which has also been pretty politically unpopular. So right now they're thinking about getting rid of the entire thing here. It basically just makes it easier to catch tax evasion is what they're trying to do. Eliminating carried interest. This has a lot to do with venture capitalists and the profits that they can make over time by investing other people's money. This is not so important. Corporate rate hike. Okay, so this was big, raising the corporate tax rate from the current 21%, which keep in mind Donald Trump reduced it from 35% to 21%. Raising this back up to 28% led the stock market, or the idea of this led the stock market to shave like 5% off right away. We've kind of been having a little bit of an end of the year rally now, and part of the reason I believe is because the talk about raising this rate has so far been deleted. It looks like this is probably not going to happen. We're not going to see an increase in the corporate tax rate, which has been very good and cheered by investors. I've been investing like crazy in February, March, April, May, June, July, in a lot of the dips that we've had in the market, whether it's been in crypto or stocks. And everything is doing so freaking well right now, which is totally awesome. It's been making it a little bit harder to buy. I'm still looking for opportunities that are left over, and I invest in opportunities that are left over. And if you want to see all my buy-sell alerts, obviously, those come with the Stocks and Psychology of Money program, link down below. Check that out before the coupon expires. But anyway, higher individual tax rate. This is raising the max tax rate on individuals making over, roughly married individuals, making roughly over $530,000 a year. Capital gains rate hike and estate tax expansion. These things right now are actually just straight up likely out. But what's likely in is a 15% corporate minimum on book tax. So, or on book and then a tax on that. Give you a very, very quick and dirty example of this. Let's say Amazon invested $300 billion into new factories in 2018, okay? And then they wrote this off over 30 years. Well, that would give them a 30-year straight line write-off of $10 billion a year. That makes sense, right? 30 years divided by 300 billion, that's a $10 billion write-off every single year. Now, let's say that Amazon has income of $10 billion, and they're like, yay, we made profit of $10 billion. Well, this is where all the progressives on the left are like, oh my gosh, Amazon made $10 billion, but they're paying $0 in taxes. Why? Because this write-off offsets this income right here. It makes sense. They were encouraged to invest for the write-off, and now they're basically saving on taxes because of that over time. Well, progressives are saying, well, we should tax this at least 15% or $1.5 billion in this case, regardless of the fact that they have depreciation. So that explains this a little bit. The global minimum corporate tax, similar to the first thing. The expansion of the 3.5% investment tax. Okay, so this is the NIIT, the net investment income tax, and it's really on capital gains, dividends, rental property income. It really just applies to high income taxpayers. I think you need to make more than $200,000 single, $250,000 as a married filing jointly couple. And any kind of investments you make get charged an additional 3.8%. This was the Obama tax. Expanding audits, limitation on business losses, surtax on millionaires, levy on corporate tax, stock buybacks. These are all things being considered right now. The surtax on millionaires, This would basically levy an additional 5% tax on income above $10 million and an additional 3% on income over $25 million. So just extra taxes for the wealthy. Now, in addition to that, there has also been a discussion about a potential billionaires tax. And this was really a way of affecting 700 to 800 of the wealthiest Americans. And the idea here was to basically tax wealth. This would require audits to be done. This is kind of complicated to audit not only the stocks, but the real estate and probably the crypto and all of the assets that billionaires have. And the idea here is really to help pay for the Build Back Better plan. There've been a lot of negotiations about this, but a lot of folks see this as the perfect way to tax the rich. And they use famous quotes like how Warren Buffett pays a lower tax rate than his secretary, even though he pays more in taxes, pays a lower tax rate. That's because long-term capital gains are taxed at lower rates than income, right? Ordinary income. And so the idea here is, hey, well, if we audit how much wealth billionaires have, then we would be able to tax them at some form of level on the wealth that they've created. Now, some rumors have been that they could get taxed as high as 25% on their wealth on assets they haven't even sold. This seems a little misaligned with general investor mindsets. Like if you haven't sold anything, you shouldn't have to pay taxes has always been the idea. But that leaves a lot of folks like complaining that people like Elon Musk can just enjoy their stock price going up forever, and they just take little bits at a time to fund their lifestyle. But as their wealth goes up and up and up and up, the government actually isn't realizing any kind of tax on this. And so this, of course, is leading people like Bernie Sanders and Elizabeth Warren to substantially support this. So they say the money is going to come from billionaires who, quote, don't pay their taxes and therefore have enough money to shoot themselves into space. Warren has been talking about a 2% wealth tax, which is different from like the capital gains style rate, up to 25%. That rumor seems a little extreme. It's more likely to see something like what Elizabeth Warren is saying, like a recurring 1 or 2% wealth tax, essentially, rather than just like a one-time tax hit on appreciated wealth. Now, what's interesting is Kyrsten Sinema, which is the holdout vote for Democrats, has highly opposed any kind of higher taxes on even, let's say, marginal income tax rates, but has supported a wealth tax on billionaires. So this is potentially a way to get some taxes through. Pelosi says that this would raise about $200 to $250 billion over 10 years. Some argue that the wealth tax is not constitutional. They say that the Constitution only has the ability to issue direct taxes. That's a quote directly out of the Constitution, and they say that direct tax would mean like direct income, and that wealth is not a direct tax. So this is something that could potentially get argued in the Supreme Court if it came down to it. This would, for example, cost somebody like Elon Musk up to $50 billion if enacted, which again seems this would be on the extreme end if they went for the highest potential one-time wealth tax of something close to the capital gains tax rate on gains. And a lot of folks say, like Elon Musk has said, look, the United States debt is $28.9 billion. He says, even if you taxed all billionaires at 100%, you'd only make a small dent in that number. So obviously the rest has to come from the public, and Elon Musk sees this as just basic math. He says that him using his money is really good for humanity. He was quoted saying, "My plan is to use the money to get humanity to Mars and to preserve the light of consciousness." So maybe put us all into robots. Okay. Other opponents like Steve Mnuchin, the former Treasury Secretary, says that a billionaire tax is likely unconstitutional and will have a lot of unintended consequences. The chairperson of the Ways and Means Committee has said that this is coming too late in negotiations and that he also isn't sure that it's constitutional. Joe Manchin does not support a wealth tax. He believes that everybody should pay their fair share, but the bill unfairly targets billionaires. He says there's a lot going on with this and it's very convoluted. I believe there's going to be a way everyone's going to be able to pay, but I believe we will end up in a way where it's not just billionaires paying, that everybody has to pay. So it's also worth noting that half of taxpayers pay 97% of federal income taxes. Take a look at this chart right here. I'll hide myself for a moment so it's easier to see. On the bottom right there, you see what top 1% share of income taxes paid. The top 1% paid 40.1% of all income taxes, and then the next 3% pay about the next 10%. So that's how you get to the top 3% paying 50% of all federal income taxes. And you could see the bottom 75% only pays about 13 to 14% of all the federal tax revenue that the United States government receives. So then what this is really coming down to with the billionaire tax is the belief that wealth is much more concentrated and that wealthy people should pay more. Now, there's some surveys on this. In a 2020 survey, 58% of Americans said the existence of billionaires was neither good nor bad. And this is really the opposite of what we saw in the 1800s and 1900s, which is a little more historical, but we had a whole lot more anti-wealth sentiment back then than we do now. There was a lot of anti-landlord, anti-manufacturing, anti-owner sentiment in the 1800s and 1900s, and that's really subsided over time. But there is a really big difference between what young people believe and what older folks believe. In 2019, the Cato Institute found that Americans under 30 were 20 to 35 points more likely to resent the rich, and 39% went as far as saying it is immoral for society to allow billionaires. That's 4 out of 10 people in America under 30 believe it is immoral for society to allow billionaires. This is more than 3 times the rate of resentment and anger felt by those over 65 years old. So those over 65 have more of this understanding of, well, maybe those folks earned it and they worked hard for it, whereas those under 30 have a completely different view that, no, this is not a socially just thing. So we'll see if, as younger generations become older, if that sentiment sort of changes. But either way, there are going to be some big taxes to be paid, so we're going to have to, take a little bit of money here. I can't get it out. We're going to have to take a little bit and start paying some taxes, I guess. Anyway, just in case you're wondering, this is a stack of $2 bills, and let's just say it has to do with a special event coming up this weekend. All right, folks, check out those programs linked down below, and we'll see you in the next one. Thanks again. Goodbye.